What's happening, everybody? It's your boy Creative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all. We're going to be going over and dropping a new episode in our Creative View series. Now, Creative View is a place where we break down different financial topics, being able to go down different ETFs, understanding AI agents, being able to really get into the weeds of machine learning, right? Or even building algo bots. Now, today I have something super excited for you. We're going to be breaking down QQQ. QQQ is the top 100 tech companies within the Nasdaq, and we're going to be going over this properly, right? So if you haven't already, I need you to go ahead and like and subscribe. So let's go ahead and jump on in. Now, what is the Nasdaq 100? Now, we're going to be the way we're going to be doing this. I have 6 lessons for y'all, and it's not going to take us more than an hour to do this, so don't worry. And after each lesson, we're going to be checking for understanding. So I need to make sure that you're following, and go ahead and type your answers in the comments and to see if you got it right or not. So go ahead and pay attention, and I'll definitely make note to some of the things that you should pay attention to as we're going over this. So the Nasdaq 100 is going to be the top 100 non-financial companies in the Nasdaq, right? The difference between the Nasdaq and the New York Stock Exchange, the New York Stock Exchange is the oldest exchange here in America, right? And then the Nasdaq is going to be the tech cousin, right, of the New York Stock Exchange. So when you think of the New York Stock Exchange, so you know how you think of people submitting orders like an actual ticket of buying and selling, where the Nasdaq, everything is on computers, right? So it makes sense why it's tech heavy. QQQ is the Invesco QQQ ETF, where you can buy the Nasdaq 100. It is tech heavy, meaning that there's a lot of tech stocks, meaning that there's going to be more risk, but you don't risk it. You're not going to get what? The biscuit, which is the reward potential. Non-financial is meaning that there's no banks allowed. The Nasdaq 100 purposely excludes them, right? So, and then there's growth stocks, and those growth stocks are the expected to grow fast, higher risk, higher reward. What does that mean? You got to risk it in order to get the what? The biscuit. So imagine you're picking the 100 coolest, fastest growing companies on the Nasdaq Stock Exchange, right? So some of those companies would be Apple. That would make sense because of your iPhones and then your MacBooks. Then you have Nvidia, AI chips that are powering ChatGPT. Then you have Tesla with the electric cars. Then you have Netflix with streaming. Then Google, Amazon, Microsoft. You know Walmart is in there too, but I'll show you more. Big thing here is that no banks are allowed, right? So the Nasdaq 100 rule. The Nasdaq 100 is the tech's dream team. So technical definition, you probably want to make note of this, is the Nasdaq 100 is the 100, excuse me, the Nasdaq 100 tracks the 100 largest non-financial companies on the Nasdaq. It heavily tech focused, 63% technology. Memory trick, Nasdaq 100 equals tech plus innovation, no banks. Quick facts, actually 102 to 103 stocks. Some companies have 2 shares. No financials, banks, insurers excluded by rule. Tech equals 63%, nearly double the S&P 500's 34. And this is growth focus. Innovation is greater than stability. So here's a live look at the Nasdaq 100 data. It's currently at $25,267,086. It is up about 0.77% today. The 52-week high, 52-week high is about $26,182.10, and the 52-week low is about $10,000 less than that, right? QQQ is going to be the ETF. QQQ's price is at $614.32, and more on this in a bit. So here's the sectors of the Nasdaq 100. So as you can see, technology dominates. Then we have consumer cyclicals. We have consumer defense, healthcare, communication services, industrials, utilities, and then basic materials. I wonder what the basic materials are. Maybe I'll do a search on that later. Let's keep going. Let's stay focused. So tech dominates at 63% versus SPY 34%, right? No financials. That's Nasdaq's 100 rule. So the Nasdaq 100 versus the S&P 500. So 100 versus 503, which is really 103, 102 versus the 503. Tech is 63% versus S&P 500 34%. Financials, there's no banks, whereas the S&P 500, there is a banking sector. Focus is going to be growth, whereas the S&P 500 is balance. Volatility is going to be a lot higher in the Nasdaq 100 versus the S&P 500 is going to be a little bit lower. Bull market, QQQ wins, and a bear market is usually SPY. So before we jump into our quiz, let's go ahead and jump and look at the Invesco QQQ ETF, right? Allows us to be able to gauge some of the holdings, right? We already went over the sector allocation. There's no reason. As we can see here, real estate. So that's one thing we didn't mention. Basic materials always there. So that's just one thing we didn't cover here. So let's go look at some of the holdings of QQQ. There's Nvidia, Apple, Microsoft, Amazon, Facebook. This is Google. Tesla, Walmart. Told you Walmart. That's an interesting one. Broadcom. Let's just go into the middle. Coca-Cola is here. Anaflim Pharmaceuticals Incorporated. Old Dominion. They're a trucking company, so that's interesting. Microchip Technologies, right? Takes Two, innovative. If you play 2K, these are the people that make 2K. Normally, like 80% of individuals, if you get a paycheck or work a job, your check is going to be from paychecks. Right? Charter Communications, Kraft Heinz, Ketchup. That's interesting. Nissan, so that's the car. So as you can see, quite diversified. PayPal, Dr. Pepper, Datadog, right? So you can see quite diversified, fam. Let's go ahead and jump into our quiz. How many companies are in the Nasdaq 100? Exactly 100 companies? Not really. You weren't listening if you're going to say that. Actually, it's 102 to 103. Some companies have multiple shares. 500 like the S&P 500. Probably not, fam. Why are there no banks in the Nasdaq 100? It's the rule. It excludes financial companies. Banks are profitable enough. That's hilarious. Banks don't trade on the Nasdaq. Not really. It's just the rule for the 100 that there's none. What percentage of the Nasdaq 100 is technology? 34%, same as the S&P 500. Probably not. 50%, half of the index. That's interesting. Or is it 63%, nearly 2/3? All right, beautiful. So the tech dream team. So Invesco is a company that created QQQ. It is like State Street made SPY, right? Concentration, how much weight is in the top stocks? QQQ is 48% is in the top 10%. That's crazy. Whereas the top 10% for SPY, if you saw a SPY video, I think that was at 34%. So about like a 14% delta we're seeing here. Whereas the top 10% of QQQ makes up 48%, which is crazy. The annual fees, damn, that's wild. I didn't think that. That's a little bit higher than SPY, right? 0.2% versus SPY's 0.09%. How easy it is to trade is QQQ is one of the second most liquid ETFs out there. And then TQQQ is 3 times the leverage of QQQ, triple returns, and also triple the losses. So it's super risky to trade TQQQ. So the Nasdaq 100 is the scoreboard. We can't buy it. QQQ is the actual team that we can invest in. So think of QQQ as a slice of the 8% of Nvidia, 8% of Microsoft, 8% of Apple. The whole blue bubble, green bubble family got mad at me there. 6% of Microsoft, 5% of Amazon, and 96% of other innovative companies. QQQ equals the tech all-star team in one trade. So technical definition is QQQ, or the Invesco QQQ Trust, was launched in 1999, tracking the Nasdaq 100. The expense about 6 years after ETFs were launched, they decided, okay, you know what, we need one. And that's kind of crazy that they launched in 99, because what happened the year later? Y2K. What happened the year .com bomb, right? So that's kind of funny, and more on that later. So 0.2% expense ratio, 400 billion annual assets under management, or AUM, and it's the second most liquid ETF after SPY. Now, curious, this little question for the group, right? Why didn't QQQ start right after SPY? Like, why did you wait 6 years and damn near at the top of the bubble, of the .com bubble? But more on that later. So here's a live look at QQQ. It's currently priced at 614.32 and it's up $4.64 or 0.77%. The volume today was 55 million, so just under, about a million under, about 900,000, 800,000 under is average volume. QQQ details: assets under management is 402 billion. Expense ratio per year is 0.18% per year. It holds 92 stocks. Damn, bro. Whoever made that decision. And more on this later. You're going to see why this is like, he's bringing this home now. And, well, okay. Started March 10th of 93. So here's the holdings of QQQ, but we already looked at that. So nice little snapshot of it. And then the expense ratio of it. Now, QQQ is going to be a little bit higher. Why? Because it's tech focused. 100 stocks, 63% of it is in tech. Whereas SPY is going to be 503 stocks, 34% of it is in tech. So Vanguard is going to be same as SPY, is a little bit cheaper. QQQ is growth tilt, whereas SPY or Vanguard's QQQ is core holding. Warning. TQQ is the triple leverage of QQQ. So 3 times daily returns of QQQ up or down. So if QQQ is up 5%, TQQ is up 15%. If QQQ is down 5%, TQQQ is down 15%. Decays over time, losses value in sideways markets. Not for holding, day trading tool, not an investment. Can go to 0, multiple days equal, bad days equals wipeouts. Only for experienced traders with risk capital. Money to blow. I just one of those things like somebody, oh, let's trade, bro. If you don't get the fuck, why? You know? What is the expense ratio of QQQ? We already know that it is the 0.2%. QQQ charges 0.2% versus SPY 0.09%. You pay a little bit more for the tech concentration. That's $200 a year on $100,000 versus $90 for SPY. How much is QQQ in the top? How much of QQQ is in the top 10% of the holdings? It's not 38% of SPY, right? It's a little bit more, 48%, more concentrated than SPY. What is TQQQ? The 3 times the leverage of QQQ, right? We just went over that example. All right, so let's go to our third lesson: historical returns and the volatility trade-off. Outperformance, beating the market. QQQ often beats SPY in bull runs. Volatility is the price swing. QQQ swings more than SPYs because it has higher risk. Drawdown recovering, peaks to the bottom, loss, right? QQQ drops harder and crashes, bounces back. QQQ recovers faster in tech rallies. Beta is the market sensitivity. QQQ beta is 1.12 equals 12% more volatile. .com bubble is the 2020 tech crash. QQQ fell 83% because, bruv, you bought it or you started QQQ. ETF started, SPY started January 22nd of 93. That's when ETFs first launched. SPY was the first one. It's like, bet, we out the gate. I'm here. 500 of the biggest companies, right? So tech was already in there, right? So stock market wasn't a novice thing when it started. So for QQQ to wait 6 years, kind of almost deserved that, right? It took 15 years for it to recover, fam. So that's the thing about being able to yes, it recovered, but 15 years, bro. Period where investment goes nowhere, right? QQQ from 2020 to 2015 because you started at the .com bomb, right? You started 6 months before it dropped. Then once it dropped, it just kept going. So in bull markets, QQQ zooms ahead, 40 to 50, even 60% returns. SPY is steady, 25, 30% returns. But in a bear market, QQQ crashes hardy, negative 35, almost 40% returns, whereas SPY falls less. QQQ is more risky, but you get the biscuit a lot better, right? Or more pain, right? So QQQ exhibits a higher belt beta of 1.12 than SPY, meaning 12% more volatile. In a bull market, tech leadership drives outperforms. In bear markets, it gets crushed with the first hardest drop, right? So QQQ beta of 1.12, it amplifies the market's move by 12%. All right, so here is QQQ and SPY volatility comparison. So we have the COVID crash, right? The recovery. Then we have the bear market, then the tech rally, and then the beta of all them three. So as you can see, QQQ losses amplify, but the runs were better, right? Losses amplify, but the runs are a little bit better. So the risk reward analogy, tech innovation drives the economy. The low interest rates help the growth stocks. Investor optimism equals money flows to stocks. QQQ beats SPY by 10 to 30% annually. But on the inverse, rising interest rates underperform techs, right? Because there's less money for them to be able to invest in R&D, less money for them to be able to borrow from the banks, right? Because it's more expensive in a bear market. Fear, investors flee risky stocks first. Tech sell-offs harder and faster. QQQ underperforms SPY by 10 to 15%. Key insight is higher returns equals accepting the bigger the drop. So you got to risk it to do what? In order to get that biscuit. So here's the dot-com bomb, right? So QQQ launched March of 99, almost the exact top of the biggest tech bubble in history. So what happened was in March 2020, QQQ peaked to 120, the euphoria, right? Because everybody was like, yo, we in something, we got it, right? Then, so a year, QQQ popped, right? Then 2 years later, it went down to 20 bucks. I probably would have went not all in. I probably would have, if I would have known a little bit better than what I know now. It's like, bro, why didn't I get QQQ? I could have just, okay, thank you. DCA, waiting, still waiting. QQQ finally hits the 120 15 years later, right? If you bought QQQ at the 2020 peak, it lost 83 cents for every dollar. Waited 15 years just to break even. SPY recovery took 7 years in that same time, right? In that same time frame with the dot-com crash. So pets.com, which is WeBavin, eToys, companies with no profits traded insane validations. Tech always goes up. Now today's Mag 7s are profitable. We have Apple, which is the Magnificent 7, which is Apple, Microsoft, Tesla, Nvidia, generate massive cash flows. Fundamentals are stronger, but the lesson still applies. Concentration risk is real because you have 63% of it, which is still in tech. But again, it's a little bit more harder. And it's not like pets.com or WeBav or eToys, right, where the valuation didn't make sense for the companies. There's still some of that going on right now, but it's not as crazy as it was back in the early 2000s. But that's still kind of dumb because it doesn't make sense for whoever the fuck, bruh, was doing this. I don't know why they didn't pop off after SPY, because SPY started 6 years before them, but they wanted a way damn near at the top of the bubble for them to drop. But let's keep going. All right, so what is QQQ's beta compared to SPY? So we just talked about this. So by process of elimination, we're able to deduce that it is C. In 2020's bear market, which fell harder, QQQ fell 33%. Techs got crushed. SPY only fell 33%, the same drop. Not really. It's about half of that. QQQ only fell 19%. Techs protected. That's funny. So just by process of elimination, we're able to get the answer there. What is the best time to hold QQQ? During a bear run? Probably not. It's depending on how you trade it, but probably not. During a bull market, tech leads the way, right? Timing doesn't matter. Same time as SPY. It does. So just by process of elimination, we're able to deduce that. All right, so tech concentration risk and the Mag 7. So that Magnificent 7, we talked about that before, is Apple, Microsoft, Nvidia, Google, Amazon, Meta, Tesla is 40% of the QQQ. The sector risk is 63% of it is in tech. So if tech crashes, QQQ crashes hard. Diversification, only 100 stocks. So it's less diversified than SPY 503. So it's really 502, 503, depending on how you look at it. Top heavy is 10% equals 48%. Mega caps control everything. Thematic, focused on tech and innovation themes versus broad market. and special rebalance. Emergency weight adjustments reduce concentration. So imagine a basketball team where 3 players score 70% of all the points. If the 3 stars have a great game, the team wins big. But if the 3 stars have a bad game, the team loses badly. So, never mind. Let's keep going. I'm not going to do that. That's QQQ's problem. The Magnificent 7 is 40% of the entire index. Then here's the Mag 7, right? So if the Mag 7 crashes, QQQ crashes, period. Technical definition is QQQ's top 10 holdings equals 48% of the funds. If the Mag 7 alone equals 40+%. So this concentration amplifies both the gains in the bull market and the losses or crashes that can exhibit in the bear market. Less diversified than SPY, which has 38%, which is still kind of top heavy in my opinion, that is concentrated within the top 10. So memory trick equals the Mag 7 plus the 93 other companies for QQQ. And here's a look at the Mag 7 and the way that they're dominating. As you can see, each and every one and single of them are over at what? The big T, homie. Each one is carrying $1 trillion, which is crazy. Concentration comparison, the top 10. QQQ is a little bit more risky. Mag 7 weight, we have QQQ is a little bit more higher. Number of stocks is QQQ is a little bit less diverse. Tech weight is QQQ is almost 2 times the performance. Here's a double-edged sword that we have to be able to keep into mind. When concentration helps. So in 2023 and 2025, the AI boom, NVIDIA went up 500%, and that lifts QQQ, right? So big tech can have pricing power plus cash. Mega caps attract most investors, and then QQQ outperforms the broad market. When concentration hurts was in 2022, the bear market. Raising interest rates, so it's less, they have less money to be able to go borrow from banks, less money to be able for innovation, less money for R&D, right? So tech valuation crushed. Big techs equals the first to sell offs. There's no defensive sector, utilities or healthcare. Results, QQQ fell 33%, while SPY only fell 19%. Bottom line, QQQ is not a diversified bet on the economy. It is a leverage bet on the Mag 7. So special rebalance. When the concentration gets too extreme, Nasdaq pulls the emergency brake. What happened in July of 2023? Mag 7 grew to 55% on the Nasdaq 100, the AI hype. That's more than half of the index in just 7 stocks. The Nasdaq triggered a special rebalance, forcibly reduced the top stocks' weights, redistributed to smaller holdings. The rule: no single stock can be more than 24% of the index. All of the stocks over 4.5% can total 48% combined. If breached, special rebalance is triggered. Why this matters for you? Nasdaq has a built-in circuit breaker for concentration. S&P 500 has no such mechanism, but it would make sense because if you're tech heavy, you got to be able to have redundancies in place in order to account for different things that can happen to the market. So that makes sense. 48% of the top stocks is still very concentrated. The safety net helps, but it doesn't eliminate the risk entirely. What is the percentage of QQQs diversified in the Magnificent 7? It's going to be 40%, heavily concentrated there. And the Mag 7 is going to be your NVIDIA, Apple, Microsoft, Amazon, Meta, Google, Tesla, nearly half of QQQ if they crash. So how many stocks are in QQQ versus SPY? It's 102, 103 versus SPY 100. Both 500 are, that's crazy. So it is going to be A just by process of elimination. What's QQQ biggest risk? The expense ratio is too high. That's one of them. That's a good answer, but that's not the best answer. Is the tech concentration, right? 63% of tech, 48% and top 10 not liquid enough to trade. That's not really it. QQQ second most liquid. All right, so the volatility playground. QQQ options is the second most liquid option after SPY. Premium is the option cost. Higher volume equals higher premium. Volatility trades is QQQ options equals we're betting on tech volatility. 0 DTE are option contracts that expire the same day. And hedging is using puts to protect tech heavy portfolio. So QQQ options equals betting on tech volatility. So think of it like concert tickets. The normal band SPY ticket costs $50. Band shows up, play the decent show. The rock stars, right, QQQ costs $120, $70 more. higher premium, right? Might be epic, but might get canceled last minute. Higher risk, but higher equals the higher ticket price. Options, QQQ options cost more because QQQ moves more. QQQ equals the second most liquid option market after SPY. Higher implied volatility equals higher premiums, and that's popular for hedging tech portfolios, volatility trading, or directional bets. Memory trick, QQQ is 25% versus SPY 18% equals 48% of premiums. So here's a live look at the QQQ options, right? So here's the QQQ calls and the puts. So as we can see, it is a bit pricey, fam. So here's some of the popular strategies from QQQ, or we have zero DTE speculation. So option risk is higher premium equals bigger losses if we're wrong. Tech volatility equals rapid gains or wipeouts. And then we have data decay accelerates near expiration. So only trade options with money that you can afford to lose. Again, this is not financial advice. If you do see financial advice, please make sure you talk to a certified financial planner, those that are licensed in order to assist you with your financial questions. This is merely educational. Why do QQQ options cost more than SPY? QQQ is more expensive per share. Higher volatility equals higher premiums. What does zero DTE means? Options with 0 days to expiration. Options that are expired. Yeah, I'm just not going to entertain those. What is a covered call strategy, right? So a covered call is we buy QQQ options plus buying a call, leveraging up. We own the QQQ share, so that sounds a little bit more because we're covering, and then we're selling the call. We want to be able to earn the income, right? Or we sell QQQ shares and we buy a call, hedging short. So just by process of elimination, we're able to deduce that it is being beautiful. All right, so when to choose what's best for you, right? So here's our market definitions. So SPY is buying the whole mall, right? Apple Store plus Nike, Starbucks, banks, and healthcare. It's balanced, it's stable, it's boring, but guess what? It's reliable. It's good in all weathers, bulls and bear market. Whereas QQQ equals buying just the tech stores, which is going to be your Apple, Microsoft, Nvidia, Tesla, and Meta. This is exciting. You got to expect volatility, but you got to risk it, but you may lose the biscuit, right? So tech booms, terrible, and tech bust. Most people have 70% SPY core and 30% QQQ as satellite to be able to speculate. So SPY is the core broad market holding, 503 stocks, 34% in tech, and a 0.09 fee of expense ratio. Or we have QQQ, the satellite growth tilt, 100 tech companies, right? 63% of it is going to be in tech, and then is going to be 0.2 expense ratio. The portfolio construction for stability is QQQ upside. So memory trick, core equals SPY, satellite equals QQQ. And here's a live look at them and the ultimate comparison chart, right? To be able to understand it a little bit more. So why does QQQ pay such a low dividend? QQQ yields is 0.05 versus SPY approximately 1.3%. Why the big gap? Tech companies make a choice for their profits. A, pay the dividend, share cash with the investors, banks, utilities, old companies do this. Here's cash now. Whereas B, reinvest in growth, rebuild for the future. Nvidia spends $12 billion on R&D, which is for AI chips. Amazon's reinvest in AWS, logistics and AI, will make shares more valuable instead, right? So they're saying that, all right, we'll give you the money now. Most of companies, right, that pay dividend, and others are saying, all right, we're just going to make the underlying shares that you hold a lot more valuable instead. Or we have C, which is a stock buyback, which is buy back their own shares. Apple bought back 700 billion of its own stock. Fewer shares equals each share is worth more. It's like a dividend, but it's tax efficient. So here's real examples of the dividend yields compared to SPY dividend yields, right? Bottom line, QQQ is bet on the price growth, whereas SPY equals a balance growth plus income. These are two different strategies. So here are some examples of when you'll choose QQQ or SPY. And here's some smart portfolio examples based on your risk tolerance and your timeline. So here's some final wisdom, right? So you don't have to choose one, right? So most successful investors choose both, right? Have their SPY as their core and then QQQ as their satellite, which is for their growth booster. One thing to be able to keep in mind is that you have to be able to make decisions that make sense for you, right? What we just wanted to do is provide y'all with the information such that you can be able to make decisions that make sense for you and your household. So I really do appreciate y'all for sticking in. It is your boy Creative. We will be back at it again with another episode. If you haven't done already, go ahead and smash that like and subscribe button.